And I think there's a couple different ways you could look at it. And people who haven't bought into this narrative or haven't fully grasped what the problem is, they look at something like the price of Bitcoin and say, well, that must obviously be a bubble, because I've seen what bubbles look like before. Whenever anything goes up and to the right in a parabolic kind of rise, I know that's a bubble. I've seen this movie play out before. But, there are kind of two very logical explanations that you've covered in this exact talk, which is one, if you look at the US dollar, the government is essentially doing every single thing that they can to debase that value, right? So you could almost look at it as the Bitcoin or the US dollar is hyperinflating relative to Bitcoin. Then you could also look at it from the perspective of there's this, totally unique monetary network. And what you're actually looking at is an adoption curve, right? Of people adopting Bitcoin, and it becomes more and more valuable the more and more people adopt it. So you've got this very unique view of a kind of a macro strategist, but also as a technologist at heart. When you look at something like what the price of Bitcoin is doing right now, what is the fundamental input that's driving that?
I think that everybody's got the most important lesson is think for yourself, and think really hard. If you lived your entire life in the United States and the last 30 years, you had no monetary network, and you had the money supply expanding at 6%, then every model that you had was formed with those two assumptions. If I introduce a new thing, a monetary network, let's call that Godzilla, right? Or a monetary fire, that's one new thing. If I then expand the money supply by 24% instead of 7%, that's a second new thing. These are two new ideas, and if you didn't take them into account before, then your models are based upon history, and the history becomes irrelevant. When you say it's a bubble, it's just another excuse to not think, I think. It's just a knee-jerk reaction. For example, if you go and you chart the US dollar against the peso in Argentina, it looks the same as Bitcoin. Right, so if your definition is up to the right as a bubble, well, then the US dollar is a bubble in Argentina. If you chart the US dollar in Zimbabwe and Venezuela, it also looks like a bubble. So if you're going to take that position, does that mean you're going to dump the US dollar? Would you trade back into the Venezuelan bolivar or the Argentine peso or the Zimbabwe currency for the same reason? And the answer is no. It's obvious to you, but are you ethnocentric? If you can put yourself in the position of another country or another frame of reference, expand your worldview, then you see there are two reasons something goes up. One is it's being artificially squeezed up in a bubble. Another is there's just a rational flow of capital from a weak asset to a strong asset. And you got to ask yourself the question, are you invested in the weak asset, and is it going to the strong asset or not? I think what you see here with Bitcoin is what you see is the flow of capital from weak assets to strong assets. And go look at the price of Bitcoin in Lebanon. Right, where the currency crashed 90% or so over a year. You'll see that. Now ask yourself the question, should you buy the Lebanese currency? Then look at the price of dollars in Lebanese currency. It's the same thing, right? So if you're actually a long-term currency trader, and if you've seen a currency weaken substantially, then I think you've got a better framework for understanding what's going on here. I think that the other key point here is people keep saying Bitcoin is volatile, but people use the word volatility without thinking about it in the same way they use CPI without thinking about it. CPI is not inflation. You've just been brainwashed to think it's inflation. CPI is one of 1,000 measures of inflation. And, you could also calculate monetary inflation. It's a totally different number. Volatility is not risk. Volatility is a measure of risk. But it turns out that if you calculate volatility of LeBron James on a basketball court, he's the most volatile player. He's also the best player in the world. the winner, the superstar, is the volatile one. If you look at the volatility of Tom Brady, he's the most volatile player on the court or on the field. He's also the best player on the field and the most important player on the field. The winning team is always the most volatile. In fact, the winning everything in every field, art, music, war, Julius Caesar was volatile. Alexander the Great was volatile. Generally, the thing that's actually acting, right? If you're in a boxing ring, the fighter that's actually throwing the most punches is probably the most volatile and is also the winner. So the only reason Bitcoin is volatile for the past 12 months, by the way, is it keeps going up. If you look at it and you go, oh, well, it's volatile. Well, it's volatile because volatility measures the rate at which something doubles too. And if it doubles and doubles, and if I give you the asset and I said, well, Michael, this is going to double every year, every 6 months for the rest of eternity, it will be, by definition, the most volatile, defined by volatility metrics. Are you going to run from it or toward it? Bitcoin has been growing at 200% a year, every year for the last decade because of technical utility against monetary inflation of 7%. Okay, Bitcoin is growing 500% in the last 12 months. Why did it accelerate? Well, if I have a monetary fire, what feeds the monetary fire? Money, right? If I print money, if I triple the rate at which I'm printing money, don't you think that something that has been growing before will grow even faster? Generally, my model of Bitcoin and a monetary network is the price is going to go up based upon technical utility, adoption, and inflation, monetary inflation. So when I triple the rate of monetary inflation, that's one driver. It's an obvious driver. But I also market the asset and I slug everybody in the forehead and remind them that maybe they might need a monetary inflation hedge. And so every institution that bought Bitcoin between March of 2020 and today, and we could list 100 of them, you know them, every one of them was woken up by the change in monetary inflation rate. And so that was a jolting increase of adoption. And those two things put money in the system, which encourages technical utility. Hence, PayPal turns on. Square just added a new feature. You can now send Bitcoin to a Square cash tag instantaneously, no fee. So if I wanted to send you $50 in Bitcoin, I can do it in a second, no fee. That's technical utility. It used to be people said, oh, yeah, well, it's too slow to move Bitcoin around. You think about the amount of time and energy going in the Lightning wallets and Lightning Network and other off-chain things. That's exploded because there's more money in it. And so what you have is a monetary network that's being accreted, and the monetary energy is flowing into it based upon the actions of the politicians and the central bank, but also based upon the actions of the corporations, but also based on the actions of individuals. What happened in Turkey this weekend, where the head of the central bank in Turkey got fired because he'd raised interest rates. And now people think the interest rates are coming down and they're going to be looser in their monetary policy. That's a big marketing thing for Bitcoin, right? The stimulus package is a big marketing thing, for a digital asset.
Well, I actually heard
all of those things are playing in each
Turkey.
other.
I heard that lower interest rates actually lead to lower inflation. That's what Erdogan says. So
that's what he says. But the issue, right, is what will the individual think? Right. The Turkish currency weakened by 10% over the weekend. We can say that like arm wave it away like 10%. But if I took 10% of everything that you owned overnight, would you arm wave it away? That's volatility.
Yeah.
So there aren't that many solutions to the problem. Right. I mean, what are your solutions if you're a Turkish citizen? If you had the equivalent of $10,000 in Turkish lira, what are your solutions?
Yeah. It's not many.
Buy gold, like buy land outside of, there aren't very many good solutions to the problem. And so Bitcoin is becoming a more appealing solution as time goes on. But to your key point, if there was no monetary inflation whatsoever, it would still be appreciating because of technical utility. Because there's value to be able to move a block of digital gold at the speed of light. And people go, well, it doesn't move that fast. Well, they're wrong. It does move that fast. I can move it at nearly at the speed of light on the square layer 2 solution, and I can move it at the speed of light on a lightning network, and I can prove that I own the $1 billion or the $1 million or the $10 at the speed of light. And so the ability to move money with no counterparty risk or minimal counterparty risk and on a programmable protocol, that has utility that would cause it to grow in any event. And so one can think that there's no reason why Bitcoin shouldn't expand to flip gold and then to replace negative yielding sovereign debt and then to replace money markets and savings accounts and cash accounts. That's a pretty clear line of sight to $100 trillion or more, 100 times bigger than it is right now. And when it gets there, because it's a deflationary asset, and you can't make any more of it, it should still accrete in value at the rate that the cyber economy grows in productivity, right? That's basic Austrian economics. If the overall cyber economy and all the companies that are relying upon digital gold as their base layer, if those companies are growing 5%, then the Bitcoin will grow at 5% even after it's fully adopted by everybody on Earth, right? It's always going to be a better deal than the underlying savings account that yields nothing and pays you in a currency which is debasing at 7% a year.